didn't come with panic. No breaking news alert. No emergency meeting on financial TV. No dramatic warning from economists. It came as a quiet update inside a prediction dashboard that most people would have ignored. One line, no explanation, no emotion. Just a probability score that changed everything. High systemic volatility event likely within 11 to 17 days. At first, nobody reacted. The model had been right before, but not this right. Not at this scale. Not with this confidence. Then 8 days later, markets started moving strangely. Not crashing, not collapsing, just misaligned. And by the time experts realized something was wrong, the AI had already adjusted its prediction window. Downward, tighter, more precise. And that's when the uncomfortable question appeared. How did an AI see it before the people whose entire job is to see it first? Financial markets are built on information. Prices reflect data. Traders react to signals. Analysts interpret patterns. Experts spend decades learning how to read economic cycles, geopolitical shifts, liquidity flows, and investor sentiment. But modern AI doesn't just read markets, it reads everything connected to markets. And that distinction changes the game, because markets are not isolated systems. They are the final output of thousands of invisible inputs: supply chains, news cycles, social sentiment, credit behavior, shipping delays, policy shifts, corporate earnings signals, consumer spending trends, labor data, energy fluctuations, and humans can only track a small fraction of these at once. AI, on the other hand, can track all of them simultaneously, not just individually, but as a network. And networks reveal patterns that isolated analysis cannot see. The AI system that predicted the crash wasn't designed to forecast markets in the traditional sense. It was designed to model systemic risk propagation. That means instead of asking, "What will the market do?" it asked, "What happens across interconnected systems when small stress points begin to interact?" This is a completely different approach, because markets don't usually crash from one cause. They collapse from alignment of multiple weak signals, individually harmless, together unstable. The AI began by ingesting massive datasets, real-time trading activity, historical crash patterns, global liquidity flows, bank exposure networks, credit default probabilities, corporate debt structures, consumer confidence metrics, shipping and logistics delays, social media sentiment shifts, energy pricing anomalies. Then it built a multi-layer graph model of the global economy, not as separate sectors, but as interdependent nodes. Banks connected to corporations, corporations connected to consumers, consumers connected to sentiment, sentiment connected to trading behavior, and trading behavior fed back into volatility. Once this network was constructed, something interesting happened. The AI stopped looking for signals. It started simulating stress, not actual crashes, but pressure accumulation across the system. It introduced tiny shocks into the model, interest rate sensitivity changes, liquidity tightening scenarios, minor policy shifts, earnings disappointments, credit spread widening. Then it observed how those shocks propagated, not in isolation, but in combination. And this is where the prediction emerged, because certain combinations did not just increase risk, they amplified each other. A small liquidity tightening event combined with rising credit stress and declining consumer sentiment didn't just add risk, it multiplied it exponentially. The AI detected that the system had entered what it labeled nonlinear instability zone, meaning the market was not gradually weakening. It was approaching a threshold where small triggers could cause disproportionate reactions. Human analysts had seen parts of this. Some mentioned inflation risks, others pointed to credit concerns, some flagged overvaluation in specific sectors, but none of them connected the full system. Because human expertise is usually domain-specific, macro analysts look at macro, credit analysts look at credit, equity analysts look at companies. But systemic collapse doesn't respect those boundaries. The AI did not separate them. It unified them, and that is where it saw what humans missed: a convergence pattern, not obvious in any single data set, but visible across all data sets when aligned temporally. At first, the model output looked like noise, minor fluctuations in probability, slight changes in confidence intervals. But over time, a pattern emerged. volatility clustering across unrelated sectors. This is one of the earliest signs of systemic instability, not dramatic price drops, but synchronized irregularity, multiple markets behaving slightly off at the same time. Then came the second signal, liquidity fragmentation. Capital was still present in the system, but not moving efficiently. Money was becoming stuck in certain areas while other areas experienced sudden shortages. This is often invisible to traditional analysis until it becomes severe, but AI models can detect flow asymmetry in real time. And once liquidity becomes uneven, markets lose stability. Then came sentiment divergence. Retail sentiment remained optimistic. Institutional sentiment became cautious. Derivative markets began pricing in uncertainty. Bond yields reacted differently than equity valuations. Normally, these signals align over time, but in this case, they were splitting. Divergence across sentiment layers is a known precursor to rapid correction. The AI didn't just see one warning, it saw all of them aligning at once. Not randomly, but structurally. Which meant the system wasn't just volatile, it was primed. The moment experts noticed. At first, human analysts dismissed early signs. Markets fluctuate all the time. Volatility spikes are normal. Indicators conflict regularly. But then, something unusual happened. The AI model's confidence increased instead of decreasing as more data came in. Normally, predictions stabilize or soften over time, but this system became more certain, not less. That triggered internal review, and that's when analysts realized something uncomfortable. The model wasn't reacting to news, it was reacting to system structure. While humans focused on events, the AI focused on relationships between events. And relationships don't require headlines, they require connectivity. Once that became clear, attention shifted. But by then, the model had already narrowed the prediction window from weeks to days to a specific range, 11 to 17 days. And then the first visible market distortions began. Not collapse, but hesitation. Trading volumes shifted unpredictably. Volatility indices rose. Certain sectors decoupled from broader indices. Correlation patterns weakened. These are early signals of structural stress, but they are often ignored until they intensify. When the adjustment finally came, experts explained it in familiar terms. Market correction, macro uncertainty, liquidity adjustment, sentiment shift. But internally, the AI model described something different. System-wide probability convergence toward instability threshold. Not a crash caused by one event, but a system becoming mathematically more sensitive to small disturbances. That is the key difference. Humans explain markets through stories, AI models explain them through structure, and sometimes structure reveals instability before stories do. The uncomfortable implication is not that AI is better at predicting markets in every case, it's that AI is better at seeing the whole system at once. And markets are systems, not narratives, which means the real shift is not prediction speed, it is system visibility. Because once a model can see enough connections across enough domains, it stops predicting events and starts predicting fragility. And that raises a final question. If AI can detect instability before humans can even agree something is wrong, who is really interpreting the market anymore? The experts or the system that saw the structure first?